Thanks so much for tuning into our monthly appointment with the Motilal Oswal Private Wealth team as they jot down their note Alpha Strategist. And this time around, the note is titled Bond Royale. And lest you think that it's a paints note, it is not. But it paints a picture about what could potentially happen because of India's inclusion in the JP Morgan Global Emerging Markets Index. Arguably maybe a few more as well. The gentlemen who join us every time to talk about this note join us yet again. Ashish Shanker Nitin Shanbhag. Both of you, thank you so much for taking the time out. It's an interesting note in that there is a lot of focus that you've given in the last 30 days, I presume, or last 40 days to this bond inclusion because the note is titled Bond Royale as well.
Yeah, thanks, Neeraj. It's always nice to be here for the Alpha Strategist show. Whilst I know your viewers have a lot of interest on Indian equities and there has been a lot of momentum in the markets, but we thought what caught our attention last month was really developments in the fixed income space. We believe this development of inclusion in the global bond index for Indian fixed income bonds was a big one. And big one because if you look at the Indian equity markets, right, FIs are reasonably invested. I mean, out of the free float, I think FIs would be close to 40% holding. Whereas in fixed income, on the contrary, FIs have a very small holding in Indian government securities or Indian bonds, and we believe, I mean, basis what we have read, it could actually trigger a $30 to $40 billion inflow into Indian bonds. So we thought this is a big one, and actually it's interesting to note that in the US, right, bond yields have been under pressure of late. And that's because Fed has continued to be hawkish, inflation has continued to be sticky. But given this development, the Indian bonds have really not run up too much. The other reason why this news is really important, Neeraj, is that it changes our stance on long yield bonds in India. I mean, we've actually, after a very long time, I don't recollect when, we've given a buy call on funds which have duration, because we believe a year or two down the line, the 10-year yields or the long end bond yields in India will be much lower, and there is a very high possibility of earning close to a double digit or a double digit return in Indian long yield, long tenor bonds or funds which have high duration. So very, very interesting development. We thought we must cover it and put some spotlight on it. So maybe Nitin, if you would like to cover any more details, over to you.
We believe that India does have the necessary reserves. Today, the forex reserves are around $587 billion, right? Which gives us close to 10 to 11 months of import cover. The other aspect is the movement of the rupee vis-a-vis the dollar. And as against what we saw in the previous fiscal, where there was a sharp depreciation in the rupee, we feel that that is unlikely to be the case going forward, and the rupee should be fairly stable, which again augurs well from a foreign investor's perspective. Other two aspects are the fiscal deficit, because as and when this money starts trickling in, the government will have enough and more demand for long-dated G6, which will take care of the government borrowing program to a very large extent. And hence, the government will have the necessary armory to actually go and spend a little bit more on infrastructure and other important areas. And of course, the last is the bond yields or cost of borrowing, which over a period of time should decline eventually, and which can also help margins on the equity side.
Nitin, just wondering, is this embedded upon assumptions of some other inclusions as well? Because otherwise, this is a one-off $30 billion, $35 billion, $40 billion inflow event happening sometime mid-2024, not necessarily something that will be recurring in nature.
So inclusion in the JP Morgan index could lead to about $23 to $24 billion, because the entire suite that they cover is about 223 or 230 odd $billion. So 10% of that should come to India eventually, but it will come in stages. We are not really implying that India should necessarily get included in the other bond indices as well. As and when that happens, it's obviously going to be a positive. So as against the current 23 odd billion, that could move up to about 35 to 40. But irrespective of that, I think this is a fairly large sum of money, Neeraj, to actually come in. Even if it starts trickling in, the bond yields will not wait, right? There'll obviously be signs of buying that will come in, and hence we believe that starting mid of next year onwards, June 2024, we should see some signs of that trend going lower as far as the 10-year maturity papers are concerned.
Okay, Ashish, a question here. There are people who, I mean, everybody of course lauds this happening because it was long awaited and it finally happened. But there are people who believe that this is more something that gives a backstop to the currency, more importantly, at a point of time when the other macroeconomic variables, notably crude in particular, is not necessarily very, very favorably placed. It may not really flare up too much from where it is right now, unless geopolitics worsens significantly. But even at the current levels of $5 or $10 higher, we are entering into a worrying zone. And therefore, what this does is give a bit of a backstop as opposed to necessarily being a big positive. Would you differ?
I mean, let me put it in perspective. See, we don't know which direction crude is headed. Obviously, there has been a recent flare-up. And like we discussed, I think last month also, our base case view was that it will not sustain there and it will eventually come off. But yes, if crude were to flare up and, crude continues to be our largest import item even now, then definitely these flows will be like a backstop to the currency. The other thing to note, Neeraj, is that, while this news is fantastic, it may not immediately result in inflows like Nitin said. The other reason is also because, see, the dollar yields are also very attractive today. I mean, today, a good quality dollar bond will yield you close to 7%. And, just imagine somebody who wants to buy into Indian bonds. I mean, why should somebody take a rupee risk at the same kind of yield? So I think this kind of augurs very well, but this will happen in stages. But the moment the market realizes, or let's say gets a sense that this is going to happen, I think the yields will not wait for inflows to happen. I think a lot of the Indian domestic players could front run the yields, and you could see much lower yields even earlier than sometime mid next year. On the whole, yes, it's a positive story. I mean, in midst of all the global turmoil, and I mean, you've got another joker in the pack now, which is geopolitics. So I think all of this good news is just ensuring that it keeps the Indian rupee stable. The markets are also reasonably stable. So, India continues to seem like a bit of an oasis in what's happening globally.
Okay. I asked this to Nitin as well, but Ashish, a follow-up to you. Is there a possibility to your mind in your conversations with other people that what the JP Morgan inclusion could lead to, which is some of the others, notably the Bloomberg one or some other indices, also then making a case for India's inclusion in those indices, and therefore over a period of the next 3, 4, 5 years at different points of time, different global indices, including the Indian bonds, and thereby that inflow and the depth of the Indian bond market changing materially from what it is right now?
There is a possibility of that happening, Neeraj. The only thing is, taking a 3 to 5 year view is a little difficult in fixed income because there are so many macro variables at play, right? You have inflation, you have currency, and the Indian bonds are not exactly as convertible as equities.
That's true,
right? I mean, there are limits for FPIs, so I think we need to work on all of that, and it also makes our currency much more vulnerable. The moment your bonds become very convertible. So we also have to see how the government reacts to these developments. But in the near term, yes, there is a possibility because the limits have not been used up of, over the next 12 months, the estimate that we see is about $20 to $30 billion could potentially come in. But then after that, what is the stance that Indian the finance ministry takes? I mean, does it make Indian bonds completely convertible without any limits? Because right now there are limits. So beyond a point, even global players will not be able to invest. So all of that will have to be seen how it shapes up over the next 3 to 5 years.
Okay. Now, Ashish, of course, spoke about the investing implication. We'll talk about that with Nitin as well. But Nitin, just a quick follow-up, because there is one slide in this note which speaks about the impact on the CAD and exchange rate, right? You referred to it briefly. Now, the point I'm trying to make is, in the last 1 month, I've spoken to a few macroeconomic experts across different houses, and all of them have to say that could India move towards CAD neutrality? Yes, but is that a desirable outcome? Maybe not, because we rather be current account deficit and focusing on growth as opposed to be CAD neutral or CAD positive and resting on those laurels. Now, you mentioned this impact on CAD and exchange rate in your presentation as well. What is your thesis on this?
So one of the key drivers for our CAD in recent times or recent years has obviously been software exports, right? And that to a large extent has been relatively stable at a pretty high level. Even last year and ongoing this year, we have seen close to about $150 billion. And that is more or less offsetting the kind of imports that we are making on the crude side. That's basically why the currency is also to a large extent stable. So 1.3% is what our CAD looks at for this fiscal. We expect the same thing to continue going forward as well. And I think you're right that it'll be preferable for a country like ours to have some kind of a deficit, and where the government has the incentive to go and actually spend a little bit more.
Okay. Now Sorry, Ashish. Yeah, please make your point.
Also, the nature of deficit is important. So one is the current account, right? Current account deficit actually is not very desirable, but we can't help it because we are dependent on crude. We're dependent on import for crude. But let's say, for example, if the deficit overall widens because there is import of machinery for enhancing capex, etc. That's not too bad. That's a good idea. If you remember, about I think this was 3-4 years back, the electronic imports became a big item, and that's when this entire Make in India story started. The electronic deficit, because we were basically buying a lot of laptops, mobile phones, and that was burning a hole in our current account. I think that is now getting under control, and primarily because of service exports. And now we are cognizant and conscious, and we are telling all these global people that, hey, if you want to sell mobile phones, you want to sell laptops in India, then please make in India.
Yeah, no, that's a valid point as well. Thanks for bringing it up, Ashish. Now, let me try and focus this, therefore, on the implications on investing. Ashish started off by saying that this is the first time in a long time, I believe, that you've recommended increased duration in the fixed income portfolio. Nitin, I want you to come in and tell us what is the recommendation on the fixed income portfolio and how, because there's this slide which lays it out about how 65-70% should be in a combination of multiple things. So please lay it out for us.
Sure. So in recent months, we've been communicating that the 3 to 5 year maturity on the GSEC or on the AAA curve is a sweet spot for us, because there was really no juice to be played in from a 10-year standpoint. Now with this news, what we are saying is we are upping the maturity profile in clients' portfolios to somewhere between 7 to 12 years, right? Just to put a calculation as a thumb rule, any 10-year maturity paper typically has duration of about 6.6 years. And interest rate movement or the capital gains or loss that you make on a long-dated paper is typically measured by its duration. So, for example, if yields go down and you invest into a 10-year paper, you get two benefits. You are earning accrual. Today on a 10-year GSEC, the accrual is close to 7.35%, right? Because post the recent RBI policy, you had actually seen yields move up a little bit on account of the RBI communicating that they are going to squeeze in a little bit of liquidity. So you're going to get accrual for the next 2 to 3 years. And eventually, let's say when yields start coming down, you'll get the benefit of capital gains. How is capital gains calculated? If yields move down by 50 bips, and if your duration is, let's say, 6 years, then 6 into 0.5. So basically 3% is your capital gain benefit. If yields move down by 1%, then 6 years into or 6 duration into 1%, which is essentially 6% is your capital gain, which adds on to the accrual that you make. So this we believe is a call that investors should take in a meaningful manner. Obviously, most of your allocation would traditionally go to core, stable, accrual-oriented funds, along with the multi-asset equity savings funds. But we are saying that it would be prudent now to actually add in some bit of duration. You could either do it through debt mutual funds, which have that 10-year maturity and beyond, or you could even take exposure to directly into bonds, whether it's GSEC or AAA rated bonds. Both should serve your purpose, because there really is no difference in terms of taxation in both, albeit that in mutual funds, the entire gain comes to you by way of capital gains. In the bonds, there is an element of coupon which gets paid to you, and then there is the capital gain which will come to you later.
Okay. Ashish, a follow-up, you also mentioned that, again, we're sticking to fixed income, and then I'll move to equities for the last couple of questions. But you mentioned that to overall, and maybe Nitin spoke about it, but I'm just wanting to understand from you that in order to improve the overall portfolio yield, 30-35% of the overall allocation to be allocated to either private credit or high yield NCDs. Now, is this a marked deviation from what was the case maybe a couple of months ago?
Look, I think the credit space continues to look attractive because the overall credit profile of the country, corporates, has improved dramatically over the last 3 to 4 years. So today, structured credit funds give anywhere between, you have some performing credit funds between 12 to 14%, and then structured debt funds, which give you all the way up to 18%. So we are quite comfortable allocating part of customer portfolios in these kind of products. But the other part of the product where, you're trying to get some double-digit returns now can be simply achieved by having duration funds like Nitin explained. And just, I just want to clarify little more to your viewers, because these terms like duration, basis points may be a little complicated. In a bond fund, let's say with a 10-year duration, let's assume that the yield is 7%. So 7% is like the earnings, profits, right, over a 1 year. You will get your 7% if you stay for 1 year in that instrument. And the one-time kicker you get is when the yields or interest rates move down. Let's say, like Nitin explained, 0.5% of the interest rates go down, and 6 is the duration of the bond or the fund, then you get 3% extra. It's like a PE re-rating. So you end up getting 10-11%. So without taking too much risk on the credit side, today you can get a double-digit return is what we believe over the next 12 months to 18 months.
Got it. Thanks for that explanation, gentlemen, both of you. Thanks for simplifying it for us as well, Ashish. Now, just a brief mention on equities as well. Can't leave a conversation without that. How is that pie shaping up as we enter the Q2 earnings season?
Yeah, I think the valuations look reasonable. We spoke last time as well. I mean, you're closer to 21, 22 times on the Nifty, and this is much cheaper than where you were in 21. You were at 28, 29 kind of multiple. So earnings have outpaced the appreciation in the value of the index. So large caps are looking very reasonable. Small and mid caps have also run up quite sharply. But even there, if you look at the fundamentals, Neeraj, your ROEs are now upwards of 15% in small and mid cap indices. The Ps are not, very, very exaggerated. They're close to 25, 24. So all we are saying is that tread with a little bit of caution and little bit of awareness when it comes to allocating in mid and small caps. And that's why we are saying that portion of the market, you should completely stagger your investments over the next 12 months. But whereas the multi-cap funds, which have a kind of combination of large and mid and small, there you could do 50% upfront and 50% staggered. So, look, there is the point that we are trying to make is, look, the next 3 to 5 years look good for equities, right? The earnings profile looks extremely good. We are going to hit 1,000 on the Nifty in terms of EPS. However, as you go higher, it's like altitude, right? The higher you go in terms of altitude, you have to be that much more careful and vigilant when it comes to your portfolio. Just ensure your portfolio is good quality stocks and fundamentally strong.
And Nitin, I'll end this conversation with you because no conversation in current geopolitical times can be complete without talking about the outlook of gold and silver. There's been a bit of a spike due to recent events, unfortunate as it may be. But what's the call from an investing perspective there?
In recent times, I've observed that most experts have kind of toned down their price estimates on or long-term outlook on gold. So from what it was maybe a couple of months ago, it has slightly come off maybe by about 8 to 10%. Having said that, gold for any portfolio for us is a hedge against heightened volatility. It also acts as a hedge against inflation. And as you have seen in any time where there is extremely heightened volatility or a geopolitical crisis or some kind of a Six Sigma event which breaks out in the world, gold and dollar are the two primary assets where a lot of money tends to flow through. So we do believe that the more aggressive the client, you should have some bucket of gold in there. And as Ashish had mentioned in one of the previous conversations, you just hope that gold does not perform, right? Which means that your other assets should be having a better outlook. But having said that, there are multiple ways to participate in gold. We believe one of the better ways is to participate through the sovereign gold bond, right? Where you keep getting a coupon payment for 8 years. And at the end of 8 years, the capital gain, there is no capital gains on that paper. Otherwise, there are mutual funds or even physical gold if someone wants to partake.
Got it. Gentlemen, lovely talking to you. Thanks for taking the time out and talking about a very different Alpha Strategist note relative to the recent past, but I guess the events demanded so.
Thanks, Neeraj. Pleasure.
Thank you.
The pleasure was ours. And viewers, thanks for tuning in to hear the conversation with the Motilal Oswal Private Wealth team on their monthly product, Alpha Strategist.